The used car e-commerce sector has gotten decimated over the past year. We went from used car prices increasing massively in 2021 to now there is little demand and prices have fallen drastically. And with the used car e-commerce sector having razor thin margins plus the lack of demand, these companies have lost about 90% of their valuations. So in this video, I want to do a comparison of a stock that I own in Shift Technologies to the leader of the used car e-commerce sector, Carvana. But I don't want to waste your time, so let's go ahead and dive right in. In order to compare these companies, we need to look at a few different variables. Not just the numbers that these companies have produced, but what are the major differences in the business model. When we look at Shift, who's looking to merge with car lots, they had a massive change in their business. And this change led them to making estimates for the back half of the year and not for each quarter. They projected to have between $270 and $290 million in revenue for the second half of the year. But just in Q3, they reported about $162 million in revenue. Now, even though this looks like it could be in line to fulfill their estimates for the back half of the year, that is not what they are suggesting. Along with their Q3 revenues, they provided revenue guidance for Q4, and it was much lower than many people expected. Shift is projected to be between $60 million and $70 million. So that means for the back half of the year, they are now projected to have between $220 million and $240 million of revenue. This is much different from the $376 million in revenue that they had in the back half of last year. But with that being said, the change in their business model should be considered, in my opinion, because it affects their path to profitability, which I will talk more about later. For Carvana, they had a decline of revenues as well by 3% to about $3.4 billion. This was definitely better than the 10% decline we saw from Shift. But given the turbulent times that we are in, there was not much guidance from the company for the rest of the year. I don't see this as a big deal because, to be fair, several companies in the stock market have not really given clear guidance. Now, many people simply look at revenues as the leading indicator for how well a company is doing. But when you think about it, if the company grows revenues 5x year after year and they are still a money-losing company, they could still run out of cash. So I believe the most important thing for a company is getting themselves to profitability. I think there are a few metrics to help us see how these companies are doing with becoming profitable, and they are adjusted EBITDA, or earnings before interest, taxes, depreciation, and amortization, and GPU, or gross profits per unit. When we look at adjusted EBITDA for Shift, they lost $30 million this past quarter. This was slightly better than last year, but this was still a significant amount for them. Now, as I said previously, Shift has made a lot of changes over the past few months. They have cut over 60% of their frontline roles in corporate positions, moved to an online approach until the merger, and are focusing on value vehicles to ramp up GPU. In this economy, profitability is most important. And so even though their revenue numbers declined, they also have cut $80 million of annualized costs from their new strategy. So this clearly seems to be the better option. Carvana, on the other hand, had an adjusted EBITDA loss of $200 million, and there are so many reasons for this. First, their SG&A, or their selling, general, and administrative expenses, have increased year over year despite the slowdown in vehicles sold. They have been criticized for spending too much money on marketing, like a 30-second Super Bowl ad. Another issue is that they simply have been behind the curve on all macroeconomic changes. They overbuilt, and this has led them to having a high amount of fixed costs. Now, I'm not saying that Shift doesn't have issues when it comes to their adjusted EBITDA, because they certainly do. But Carvana has a lot of issues for being at the top in the used car e-commerce space, and they really haven't proven that their current business model could truly lead them to being profitable. And this leads to the second metric, which is adjusted GPU. Carvana's goal is for their total GPU to be greater than $4,000 and achieve significant adjusted EBITDA profitability at current volume levels. I'm not doubting that they can get to $4,000 in GPU because they've done it before. The only thing I would say as a concern with reaching this number is that there are a few headwinds that could impact the business over the next year, including lower demand and not as many people wanting a finance option. One of the analysts said that at current volume levels, they would need to reduce close to $100 million plus from their SG&A. This is not going to be easy. And if I'm honest, that is going to be difficult for a company like Carvana that has a good amount of fixed costs. They have cut workers, which is good, but the reality is that they need a whole lot more cost reduction if they are expecting to become profitable. Shift, in comparison, doesn't need as high of a GPU because their expenses are much lower. They only need between $3,600 and $3,800 for their adjusted GPU to break even. At the same time, Shift doesn't need as many units sold as Carvana. Over the past year, they have sold over 400,000 units, and they need to maintain that level in order to be profitable. Shift, on the other hand, only needs 30,000 units sold. This is a massive difference. Now, of course, Carvana is already at the number of units needed to be profitable, but will they be able to maintain this number in a market where demand is falling and probably will continue for the next year? However, with that being said, Carvana is closer to their break-even levels, and Shift has a lot of work to do. But when you look at the cost for both of these companies, Shift has more variable costs that can be cut, so they have the ability to improve on their margins much more quickly than their competitor. And there are 4 major ways that they can do this. First is by shifting more online, so they won't need as many transactions to achieve the profitability that they have been looking for. Second, they are placing their attention on high margin units. Rather than needing to sell a bunch of cars to achieve profitability, they can focus on cars that will give them the best return, which will improve their gross profits per unit. And this is especially important in a lower demand environment. They do this by switching more to value vehicles over core cars. Value vehicles are those 8 years or older or that have 80,000 miles plus. And when you think about it, used car prices have gone up significantly, so people can't afford some of the newer vehicles. Plus, financing is much more expensive, which means that the older cars are going to be much more appealing than the newer cars. When you think about a company like Carvana, what are the cars they typically have in their inventory? The cars are about 1 to 4 years old. So we will see if they can maintain their units sold despite all of the macro changes that we have seen in the macro economy. The third way to help achieve profitability is through automating much of their operations. For now, the temporary elimination of in-person test drives and focus on the online checkout channel could reduce about 40% selling costs per unit, once again driving up the margins. The last way is through reducing their marketing expense, and as I said already, reducing corporate headcount to reduce overhead costs. Both of these are going to put the company in a position where they can reduce cash burn, which is significant for Shift. Moving to the balance sheet, I think it's fair to say that both companies are in trouble. Looking at Carvana, they have $316 million in cash and cash equivalents. So with them having an adjusted EBITDA loss of $200 million this past quarter, this does not look good. But Shift is also hurting. They have $44 million in cash with the adjusted EBITDA loss of $30 million. The only thing that Shift really has going for them is the merger, which could add more cash to the balance sheet. Now, one metric that I think is concerning for both of these companies when we look at the balance sheet is the long-term debt that they carry. Shift holds $162 million in long-term debt, which is a little less than 4 times their cash position. Carvana, however, is much worse. They have $6.6 billion in debt. That's 20 times their cash position, and this has a major impact on their asset to liability ratio. With assets of $9.6 billion and liabilities of $9.2 billion, they really have a lot of work to do to trim these numbers so that they don't go under. Shift is even worse, as they have assets of $189 million and liabilities of $285 million. However, car loss will help them with this ratio, but there is still a risk that they could go under. But the one thing I want to look at closely is their valuations. Shift is already priced for bankruptcy, as they currently have a market cap of about $20 million. Carvana, on the other hand, is valued much higher at $1.5 billion. Over these past couple of videos, I have talked about risk, and the reality is that a company's valuation plays a role in how risky the stock actually is. If these companies were 5 times what they were valued at, there is a much greater risk that they would go down given the issues that they are facing. But when I look at the valuations right now, which company is more likely to fall in price if both of them have extremely high amounts of debt? The company with a $20 million valuation or the company with a $1.5 billion valuation? Carvana could go down significantly more, but it will be much more difficult for Shift unless they go under. So when I look at these companies, I really think the risk for Shift is dependent on the merger, because they will have the opportunity to cut costs and have the cash to get them through 2023. Carvana is going to struggle to cut costs, and with the kinds of cars that they typically sell, I'm not sure how they will be able to maintain the same kinds of units sold. Plus, the debt that Carvana has on their balance sheet puts them in a very difficult position financially. The way that I see this is that if the merger doesn't go through, Shift is easily the riskiest company. But if they do make it through the merger, then they have the path to profitability, and based on how they've been able to cut costs already, I'm pretty confident that they can make it through this year. And that is why I don't mind holding my Shift Technology shares. This one has always been an extremely small portion of my portfolio, so even though it has gone down massively, it doesn't really affect my portfolio that much. Hope you all enjoyed this video, and I'll see you in the next one.